Welcome to Stock Talk with Nico Criticos. Today we're going to be going through Teladoc Health stock, and I'm going to be giving you my bullish thesis on this company. So Teladoc Health is the leader in telehealth medicine. And as you can see here, it's trading at $82 a share, down 58% on the year. And I started buying this company in the 120s. I've managed to average down now to $106 a share, and I own 40 shares. So starting off, we're going to use Nico stock market checklist to decide why this stock is a good one to buy for the future, for the long term. First up on the list we have, is the stock down or oversold? And as you can see here, it is very much oversold from its highs of nearly $300 to now $82. It is trading at a huge discount. So next up, we have revenue and net income. I put a yes for both of these because revenue, you can see here clearly the revenue has been increasing very quickly over the last couple of years. Net income is still bad. It actually got a lot worse in 2020, but over the past 4 quarters, they have managed to improve on the net loss every single quarter. So it's not healthy for them to lose money, but they are showing improvement over the last 4 quarters. So we'll see what happens there. Price to sales. This one is very interesting because this one really puts it into perspective why this company is trading, or how this company is trading at a low valuation. So here is the price to sales ratio history of this company. Okay. Right now we're trading at a 6.1 price to sales, when last year or 2 years ago, we were trading at a 19. Now, as you can see, in recent years, it's come down to an 8 or a 9, but it has not been a 6 since 2016. So it's been 5 years since this company has been trading this cheap. So that is a very bullish sign for me. Next up, healthy forward price to earnings. I put no because they don't have one because they're not profitable. Next up, is the company innovative? Do they have a moat? I put yes, they're very innovative. They're doing digital healthcare, and so that's definitely an innovative thing. Their moat, they do state in their investor presentation that they have a moat through different, like the number of connections they have, the number of members, and all these different things are significantly better than their competitors. So that's one good thing. I wouldn't really count that too much as a moat, because there's definitely other companies that can do what they're doing. They're just not on the scale that they're doing. So like you can see here, they're at 76 million members, and they're the largest in the world. So, and they just got a deal with a Brazilian healthcare company where now they're going to be able to open their services to everybody in Brazil. So that's also a very good thing for them. Next up, a growing industry. Yes, this is a growing industry. As you can see here, this is the expected market size for telehealth in North America over the next couple of years. And it went up a lot in 2020 because everybody was stuck at home, and the demand went through the roof that year. But now we're starting to catch back up, and 3 years, 5 years from now, we're going to be at these huge levels where it's probably going to be heading towards maybe $1 trillion worth of a market size for this industry. So definitely a growing industry. Next up, all these are no's. All the margins and the profitability metrics are all no's because they're not profitable. No return on invested capital is bad. Margins are bad. Cash flow is bad. Diverse revenue streams. This is kind of subjective, up to the person who's analyzing this. I put no because I think that the way they make money is through doing these digital calls. Okay. It's like a Zoom call, or you can do phone calls, whatever. And they have most of it is based off of a subscription, a monthly subscription fee. Okay. So that's the main way they make money. And then I think there's also ways where you can just have a one-time fee for just your one meeting with them. But I wouldn't really and they break it up into terms of like mental health, all these different, different chronic conditions, all these different things that they organize their different offerings into. Okay. I would not consider that diverse revenue streams, though. They're still only making money from that one way of people come to them, they pay for that digital call, and that's it. They're not offering any other things. Now, what's interesting though is they've merged with several companies, and they did the big acquisition I remember that really is important here is this one they did with Livongo. And I remember very vividly when this happened. This came out in 2020, that Teladoc bought acquisition of Livongo for $18.5 billion. And why this is so interesting is not only because, so Livongo, they make devices for measuring your health. Okay. It's things for like diabetes and stuff like that. But the important thing here is $18.5 billion they paid for Livongo. And if you look at the market cap right now, the company, you can get Teladoc right now for $13 billion. So you can buy the entire Teladoc Health company for a huge discount. And that's including this Livongo that they paid $18 billion for. So that helps put it into perspective a little bit too. Next up, we have the balance sheet. Their balance sheet looks very healthy, growing equity. Assets are more than liabilities in both long-term and short-term. And then we get to share buyback or dividend. And this is where it gets kind of ugly here, because if we look at the number of shares over the last couple of years, or just the past year, you can see increase of 90%. There's been a 90% in the number of shares. That's really bad. That means that the shares are only going to be, they're worth almost half of what they were a year ago. And so that's why when you look at it, when it hit this $300 markup here, now for it to be the same market cap as it was then, it would have to just be to $150 today. So we're looking more like $150 would be more towards the top of where this could go maybe a year from now. But yeah, that's not a great sign. So that's something to watch out for, is how many shares are they issuing. Hopefully that slows down. And then next up is big money interested. Yes, they are. The biggest one is Kathy Wood and ARK Invest. This is like we're about to find out. This is their third largest position, Teladoc Health. They own over 10 million shares, 6% of their portfolio, and $871 million worth. So there's also other big funds that are invested in this company. You can see the second biggest is Vanguard. They also own 1.6 billion. So it looks like ARK actually has $2 billion worth. So looks like they own $2 billion worth. Maybe they're down so much, that's why it's worth 800 million. But Vanguard's also invested. And so is BlackRock. So you have the big funds into this one. And I mean, it definitely says something if ARK has this stock as their third biggest position. And when you look at the stock chart, you can see before it had this huge run up because of COVID, this stock was trading at around $70 a share. Okay, $60, $70 a share, came up to 80. And that's about where we're at now. So we're back where we were, a little over 2 years ago. But yeah, those are all the things that are the why I'm bullish on this company. Okay. Then we went through Livongo. You can look through their investor presentation. It gives you a good idea of what they do, how many members they have, stuff like that. But the price to sales is so cheap on this company. And if they're the number one in this industry and it's expected to grow at the numbers that it's supposed to, then this looks like the risk to reward here is very attractive. So I'm not expecting it to get back to $300 a share, but I am expecting it to be maybe $150 a share at this time next year. So we'll see what happens with that. And yeah, thanks for watching. Comment down below if you guys have any thoughts on this. Thank you very much.